In this episode, I'm going to discuss common objections, rebuttals, pushback, initial comments whenever the infinite banking concept is discussed or brought up. So let's get started. Now, in the first two kind of comments I'm going to share was really kind of left out of a previous episode that we recorded on a particular individual's very lengthy comment that I dissected or went through line by line. And I said at that time it wasn't comprehensive, and it's not. And since then, I've kind of thought about, I should have mentioned those two, but I didn't, because he left comments on various platforms, and I thought I got them all. We thought we got them all, but we didn't. We left these two out. Maybe we left more out as we were gathering them up to record the last episode or that episode which went through his comments line by line. So anyway, I found these two, but even going through that whole process of gathering up these, his particular comments, which I'm very appreciative of commenters, even the negative ones. Anyway, as we were going through that, I thought, man, this is a great opportunity to really expand and share on the common rebuttals, like I said, misconceptions, statements, pushback, just comments when the infinite banking concept is brought up. And a lot of times somebody bringing up the infinite banking concept, if you've been doing this for 6 months, a year, or 2 years, and you're really excited about it and you bring it up, there are very common comments that are made. And some are very simplistic, fundamental, and then they get more complex as people expand their thinking, right? Okay, so the first two, like I said, are what was left out from Mark F. 2050, his big long comment. In one of the comments that he said, or he wrote, was, your loans are based on a percentage of cash value, but are funded with the insurance company's money. That's true. The loan value, what you can borrow against or collateralize, there's a limit of cash value in which you can collateralize. And yes, you collateralize that with the life insurance company, and they are lending you their money. No question about that. But he continues, that's why you owe interest to the insurance company when you take a loan. No, those are two different things. You can't blend them together, and you sure can't get clarity if you do blend them together. So the fact is, when you're buying life insurance, and you're buying a whole life insurance policy, and you're buying a whole life insurance policy that participates in the financial experience of the company, then it participates in that, and it pays you a dividend. And those are issued by mutual companies, right? So you're going to accumulate a cash value over time. There's no question. Then it depends on the structure, or you can manipulate that speed in which you accumulate cash value. There are pros and cons to do that. There's a limit in my humble experience of 20 years within the infinite banking footprint, right? And 33 years in life insurance. And I'm not saying that because I know everything. I do not know everything. But I have thousands of clients all across the country. And so I have some experience building policies for our clients with the various life insurance companies in North America. And so, I have an opinion, right, based on that experience. And of course, also based on my beliefs. Okay, so I'll get back to the question or the statement. Your loans are based on a percentage of your cash value, but are funded with the life insurance company's money. Yes, there's no question. Okay, you build a cash value. If you have permanent life insurance issued by a mutual company, preferably, there's going to be an accumulation of cash value. Now, and you have a contractual right, because the life insurance policy is a contract, and within that contract, you have the right to borrow against your cash value. Now, you look at the life insurance company, and I'm not the water boy for the life insurance companies. Okay, I'm married to my beautiful wife, Jana. I am not married to these life insurance companies. But the life insurance company, why can't you borrow 100% of your cash value? And then, of course, this industry, like every other industry, has its own terminology. So we can say cash value, net cash value, surrender value, loan value. All of those have meaning. Okay. If I get mad and quit, I'm going to surrender the policy. I'm going to tell the life insurance company, send me a check of my surrender value. I no longer want this policy in force. So the policy is surrendered. The life insurance company sends you a surrender value, which could be a net surrender value. If you already have an outstanding loan, that cash value, that is not collateralized, or part of that cash value can be collateralized, would be collateralized if you had an outstanding loan. In my example, let's say I had $100,000 in cash value, I had a $50,000 outstanding loan, which is principal and interest on the loan. I surrender the policy. The life insurance company is going to send me the net surrender value. Net of what? Net of the outstanding loan. Right? All right, it's very simple and not complicated, and it's also not nefarious when you think through the mechanics of a life insurance policy. And you don't have to be a life insurance expert to understand this or for this to make sense. Okay. So the companies obviously want the policies to stay in force. As you pay a premium, that is income to the life insurance company, right? They don't want to lose you as a policyholder. Do they want to pay the death benefit? They know they're going to pay the death benefit. They just don't want to pay it sooner than later. They want you to pay that premium over your whole lifetime or whatever the premium schedule is, okay? And so as we're going along and the cash value is building, I'm going to go to the life insurance company and exercise my contractual right and request a loan. Why can't I borrow 100% of that cash value? Because internally, if I'm at the beginning of a year, of a policy year, I have $100,000 in cash value, they are going to internally reserve. They're going to set aside interest that would be due on the amount of loan that's outstanding or the amount of loan that you can request till the end of the time period. So they're going to act like you're not going to repay the loan or interest. And then they're also going to act like you're not going to continue paying the premium. So they're going to set aside some amount for a future premium. Every company has a little bit different percentages, but they're all fundamentally the same. They're going to act like you're not going to repay the loan, and they're going to act like you're not going to pay a future premium. So you cannot borrow 100% of your cash value. Internally, there's going to be a reserve that the company is doing mechanically. That's how they calculate the loan available. Okay. Excuse me. And because your cash value is growing over time, if you continue to pay in the premium, you can't fundamentally or dumb it down or try to oversimplify that and say, well, you can borrow 90% of the cash value in year one, or 85 or 70 or 60 or whatever it is. All right. And then year two, you can't, it's not a static percentage number that is, or a percentage amount that's being reserved. And I'd really like to address these in a simplistic way, but I promise you, and you regular listeners know, that I don't dumb anything down, quote unquote. I think that you're all able and capable to manage your own affairs. All right. Okay. But then he continues, that's why you owe interest to the insurance company when you take a loan. No, that is not why. So I'm separating them. You pay interest to the life insurance company because that capital, and it belongs to the life insurance company. We've addressed that previously. I'll address it again. Whenever you pay a premium, that money, that capital is not yours. It becomes the property of the life insurance company. And then they have to take that capital or a certain part of that, all of that capital, and they have to pay their expenses. and they have to make sure that they're going to pay a future death benefit. It's a 100% chance that none of y'all listening are going to get out of here alive, including me. We're all going to graduate, right? From the life insurance company's perspective, that's a guaranteed obligation of the life insurance company. So they have to take that capital premium and put it to work to meet a future obligation that they have. They have to contractually fulfill that obligation because life insurance is a contract. And then if you have a cash value, part of that is guaranteed, part of it is non-guaranteed, right? There's a guaranteed accumulation of the cash value, and then there's a non-guaranteed component of the dividend. The dividends are declared and paid annually on every mutual life insurance company, right? So there's two components, one guaranteed, one non-guaranteed. But once the non-guaranteed dividend is paid, it's guaranteed from that point on to still accumulate in cash value, and it's still going to earn future non-guaranteed dividends. And so my point here is the premium is capital of the life insurance company. The life insurance company has to put that money to work, that capital to work, to meet the future obligations, one of which is death. You're guaranteed to die, period. Okay. Well, then if it has a cash value, and all cash value whole life insurance does have a cash value, then that is also a contractual right that you have, which is a contractual obligation to the life insurance company. If I got mad and quit, I'm the policy owner. If I get mad and quit in 10 years, there's a cash value in 10 years. That's a guaranteed obligation to the life insurance company. So I reiterate, when you pay a premium, it's not your money. It becomes the property of the life insurance company, and they have to put that capital to work to meet the future obligations. Those are the two guaranteed obligations that the life insurance company has. All right. So you do not owe interest because the company's internally reserving. You owe interest because that company is taking capital that they have put to work to meet future obligations, and now so it's earning a rate of return. It's earning a interest rate at the life insurance company to meet their future obligations. When they take that out of their portfolio or wherever they have that money to work at, it's very limited on what a life insurance company can do with their capital surplus. All right. They can't go into the stock market. Why can't they go into the stock market with capital reserves? Oh, I don't know. What's a guaranteed rate of return in the stock market? There is none. Well, how are you going to put your money to work? Anyone. How are you going to put your money to work on a non-guaranteed basis to meet a future guaranteed obligations? Yeah. Okay. So let's say if they're earning 5% in their capital portfolio, and they turn around and fulfill the contractual obligation they have, which is your demand for a loan, a request, one-page service application. They don't care what you do with the money. All they know is they're fulfilling their obligation, contractual obligation to produce a loan for you, which is a contractual right that you have. So if they were earning 5 over there, they sure cannot charge you less than 5 on the loan interest rate. Can they? Well, they could. They can't. But if they did, then that is going to affect their overall rate of return, meeting the future obligations of the life insurance company, which is the death benefit of the cash value, as I said. So the company charges you interest because they have to have interest on the capital that they have put to work. That was almost a too long of a perspective from my side, right? It's very simplistic. So, well, you own the company. So there's, two types of companies, right? Stock company that's owned by stockholders, shareholders. And then there are mutual companies that are owned by the policyholders. So if you're practicing the infinite banking concept, and if you are practicing the infinite banking concept or want to or wish to or considering practicing the infinite banking concept, you want a mutual company. And there are mutual, as a side note, there are mutual companies that write universal life policies. You do not want a universal life policy just because they're owned by a mutual company is, producing those products. So if you're an owner of the company, why wouldn't you do why wouldn't you do an interest-free loan? You own the company. That doesn't even make sense. If you own the company, you want it to be successful. You want it to be profitable. You want it to surely be in existence whenever you die or in the future whenever you want a loan, right? So, and all you business owners, if you give yourself interest-free loans from your business, you're violating some very fundamental facts, right, of economics. And if you're practicing the infinite banking concept and you're not repaying your loans or you're not paying interest, you're paying lip service to the infinite banking concept. You're not being an honest banker, which is the third fundamental point of our Nelson Nash. Number one, think long range. Number two, don't be afraid to capitalize, i.e. pay a premium. Number three, be an honest banker and don't steal the peas. So if you're practicing the infinite banking concept, not admonishment, it's encouragement, you should be an honest banker. And we can talk at length of what that means. But very fundamentally, it means paying interest and having loan repayments. Okay? And I get that the duration or the timeline may be different on all those. Okay. Mr. Mark continues. At my bank, if I want a loan, I don't have to self-fund it first or wait 20 years to build up cash value. I don't know the basis of his comments here. As I read them, my heart kind of goes out to him. It's almost as if he's been hurt or, I don't know why he's so visceral to the infinite banking concept, but, God bless him. Well, no, he doesn't have to do anything but to qualify for a loan. If you walk into a bank, all you have to do is qualify for the loan, which requires collateral, and it's going to require more collateral than you're asking for in the loan, of course, because if you borrow $100,000, there's going to be interest charged against you, and the bankers, they're not dumb, right? You're going to over collateralize a loan, period. Right? If they have to call the loan or you default on the loan, they've got to liquidate your collateral. Their perspective is we're going to probably liquidate that at fire sale prices. And plus, now he's not going to, the borrower's not going to pay the principal back or the interest. I mean, you're going to over collateralize a loan. So all you have to do is qualify for the loan to get a loan from a bank. But the implication here, he's combining again two kind of statements, right? At his bank, he doesn't have to wait or self-fund or wait 20 years. Of course not. You walk into a bank, all you have to do is qualify for the loan, right, with all the bank's requirements. Well, the implication here, the way he's made that statement, is you've got to wait, 20 years. You don't have to self-fund. Well, part of that is true. You do have to pay premium in a life insurance policy. You're paying premium to the company. You're owning a life insurance policy. That policy didn't exist until you went through underwriting, started paying a premium. So you have to pay a premium for some time to build a cash value. Now, some policies you can borrow money from the life insurance company 30 days after a policy is in force. Does that mean you should? No. But my point here is you don't have to wait. You surely don't have to wait 20 years. You do have to wait some time period to build cash value to collateralize, right? But it surely doesn't have to be 20 years or 7 years or 4 years or 5 years, but also the infinite banking concept is not a gamified thing that it seems to have become in the big wide world of social media, where you're just buying life insurance, high premium in the first year with all kinds of, dumping and all kinds of language. You're contorting that policy. I've talked for years about Frankenstein policy, but my point here is most of the time, if there's an awful lot of the time that you're contorting the structure of a policy to get really high. They're really artificially high cash values, so you can get a loan early. There's some applications. Could that work? Yeah, in some world, the stock market is always going to go up forever, and we're going to go back to a real standard of money. Could it happen? Yeah, it could happen, but is it? I doubt it. Okay, I don't want to get too far off the mark. Okay, his bank, if he wants a loan, he doesn't have to self-fund or wait 20 years to build up the cash value. Nope. You walk into the bank, if you qualify for a loan, they'll give you a loan, Johnny, on the spot. But you're going to qualify for the loan, collateral and all these things, income, net worth, your credit score, all of their requirements, right? But you don't have to wait 20 years to collateralize life insurance either. But yes, the only truth in here is you have to pay a premium in a life insurance policy, building cash value before you can collateralize it. No question about that. Okay. If we continue, I want to put in here a comment that, so if I go back to the original process, it did a longer episode where I've answered or kind of pointed out line by line. I don't want to say a rebuttal, but, shared his original comment, those two comments he left out. So in that whole process, I'm thinking, man, we need to spend some time on some very basic, comments, initial comments that people have and the initial thought process that people have when they're first exposed to the infinite banking concept. And I know most of you, a lot of you, maybe all of you have heard all of these things. I'm not saying that this is going to be comprehensive, but I thought it was a great opportunity to just discuss some of these things that continually reoccur. But before I continued on that, I want to read a comment that came in mid-September 2024. And this comment was on episode 228, Into the Depths. That was an episode with Ryan Griggs and I. And that 1968 lawman, he wrote, boy, oh boy, do you guys have your job cut out for you here on YouTube. I just wanted to catch up with you guys, and I typed into the search box, banking with life, quote unquote. And the number of nonsense that popped up, and I even gave one of them a chance for about 5 minutes just to see what they would say. And of course, you can guess what a bunch of nonsense it was. Anyways, love the information and loving practicing IBC myself. Thank you, lawman, for that comment. And, I'm going to take that as a compliment. All the people that say that they practice the infinite banking concept can, mention Nelson Nash's name, my late dear friend and mentor, can mention the words IBC or the letters IBC and can string, infinite banking concept together. And then, of course, I'm just, thank you. I'll take it as a compliment. All of you marketers that want to throw my name into your keyword search and, the banking with life. And, I appreciate you. You keep working. All right. Okay. Common questions that I have heard, continue to hear when it comes to even, number one, life insurance, right? Because the infinite banking concept, we're using dividend paying whole life insurance. So there's an initial pushback of life insurance, right? Permanent life insurance. Oh my gosh, the cost is too high. The premium is too high. You should go buy term and invest the difference or invest the rest, which that's not an original idea. It's over 100 years old. Some of these arguments, it gets rather fatiguing sometimes for me. And, I eat my Wheaties and I work out, but the same things over and over and over. So maybe some of this work and some of the work that we're doing now and will complete in the near future is for me to be able to do a work and then point to it, right? You want to talk through, term and whole life. Man, it'd be great if I had a work to point to and say, you know what, go watch that. And it may help you and it may not. You may agree, you may disagree, but I don't have to say the same thing over and over and over, which, don't misunderstand me. I mean, when it's new to someone, I want someone to understand what we're talking about, and I want them to think through this whole idea of becoming your own banker. Because if you think through the idea of controlling the banking function, it's like nirvana. I mean, lights go off, you'll see things that you can never unsee again, in spite of the noise, in spite of the constructed narrative. Right, which this is part of that. Buy term and invest the difference. The cost of whole life insurance is too high. Okay, well, and let me say, and I'll probably say it again, you cannot narrow down an argument, any argument, in my opinion, but especially arguments was you're considering the infinite banking concept or fighting for it or fighting against it. You can't narrow down the argument to any one particular point. I mean, if you do, it's a flawed argument on both sides, right? So the cost is too high. Look, the pure cost of life insurance, if I'm just going to pay a life insurance company a premium to pay a benefit when I die, we're taught that, and we all believe and fundamentally understand, initially it makes sense that, well, if I buy term, there is nothing but a term period, a 10-year term, a 20-year term. I think you can buy a 100-year or term to 100 in Canada. God bless you. So there's a 10-year term, 15-year term, 20-year term, 30-year term, annual renewable term. At the end of that term, let's say at the end of the 10 years, if I buy a 10-year term policy, if I didn't die, right? Now, I may have died. If I died, my beneficiaries got the face amount and it fulfilled its purpose. No problem. But if I lived 10 years and 1 day, that premium, if it's guaranteed renewable, what does that mean? It is renewable to a certain age in the future, typically 70, 75, 80, maybe 90. If it's renewable, guaranteed renewable, if I pay the premium, which is going to go up by multiples in the 11th year. Right now, the younger you are, the multiple will be less. But if you're 65 and you have a 10-year term and you turn age 75, it's guaranteed renewable if you pay the substantial premium increase and go through underwriting again. Now, what are the chances? Say you got super preferred let's say you got preferred at age 65. Okay, it's possible. Not for guys like me, but it's possible. What are the odds I'm going to be super preferred at age 75? A lot less. A lot less. Is it still possible? Yeah, it's possible. Maybe 1% of the population will get super preferred or preferred at age 75. So my point, if I was paying, let's say $5,000 a year for a particular face amount for the 10 years, I paid $50,000 into it, but then I didn't die. In year 11, that $5,000 premium goes up to $15,000 or $20,000. How many people are going to keep that? None, or very few, and they will if they're terminally ill, maybe. All right, so the premium is going to go up in the future on term to the point where you won't keep it. It's statistics. Right now, I don't have any specific statistics to quote, but we've all heard it, and I'm sure, if I did a full work on it, I would produce some of the studies or some of the reference points where, 97, I've seen anywhere from 96 to 99% of term policies don't pay a death benefit. Why is that? Well, the people outlive the term, right? And I've said, and I have the statistics in previous podcasts, that term is the most profitable product that the life insurance company issues. All right. It is. All right. It just is. Why? Because most people don't die while the policy's in force. And then that's by rate, right? That's a higher profit rate for the life insurance company. By volume is the universal life policies. That's the most profitable product they have in their repertoire by volume. Premiums are generally higher for universal life. So you're not going to outmath a life insurance company, in my opinion. Okay, so the term versus whole life. Term is inexpensive. Whole life is more expensive or too expensive? Well, if I believe and I understand that all life insurance is priced appropriately. If you're going to pay a smaller premium at age 20 for a $100,000 term death benefit and compare that to somebody who's age 50 for the $100,000 death benefit, they're going to pay a much higher premium, right? They're both priced appropriately because both premiums are based on somebody's statistical life expectancy. How many premium dollars are you going to pay to the company right before you graduate? So, if we talk about or continue to talk about the premium, and there's arguments in the life insurance company that have gone on for a century, like I've said, term and whole life. So, which are both priced appropriately. So, whole life is guaranteed. It used to be to age 100. Now it's guaranteed to age 120. The statistical life expectancy is now 120. That's the duration that the companies use to price life insurance. So I'm going to pay a higher premium, no question, on the permanent policy. What if you compare that to term? You're not really comparing apples to apples. The term, and it's only guaranteed for 10 years if you pay the premium, right? It's guaranteed beyond 10 years if you continue to pay the premium. And the same with whole life insurance. The whole life insurance is guaranteed to remain in force to age 120 as long as the premium is paid. All right. And now when you look at participating whole life insurance, you're then going to be in a position where you're comparing the dynamic death benefit of a whole life policy to a static face amount of a term policy. Why? Because a mutual policy, or a policy that's issued by a mutual company, pays dividends. That dividend goes to cash. There's a fee for the dividend, or not the dividend. The dividend is paid, and if you have it applied to the paid up additions rider of a whole life policy, it goes straight to cash, increases your cash dollar for dollar the day it's paid, and it also increases your death benefit, and it also increases future dividends. So your death benefit is continually growing compared to a term policy that is static, right? And then you have the cash value. So there's more components to consider. There's more characteristics to consider on a whole life policy compared to a term policy. Then if we continue down that argument, and I'm not saying this is a robust work, all right? My purpose here is to encourage your thinking, expand, challenge your own thinking, right? Don't believe a word I'm saying. Go out and challenge your own thinking and read the other side, read the other comments and get past the noise. I understand there's a lot of marketing BS in the infinite banking footprint. Okay, well, what's new in the financial world? You take a good idea and the first thing a man will do is tear it down. So don't get stuck on a particular point. Right, there are so many characteristics of whole life insurance you've got to get past, or you've got to be able to compare those characteristics with the characteristics of a term policy. And then a continuation of term and by the difference. I started my career back before 1991. I know I'm an old guy. I get it. But that's where I went to work at Waddell & Reed. Right? They were a Fortune 500 company. I think they've since sold, but they had term. It was by term and invested difference. I believe A.L. Williams was a regional manager there when he went out and started, whatever he started, that multi-level marketing firm, A.L. Williams, which I was familiar with that early in my career too. Just couldn't get past the multi-level marketing part. So understand the argument. By term and invested difference. So what do people typically do with the difference? Well, they typically spend it. All right. And these people that love buy term and invest the difference, they want you to put your money, that difference in premiums. So let's say I want to pay $500 for a $100,000 face amount whole life policy, or I buy a $100,000 face amount term policy that may cost $25. All right, whatever it costs, it depends on the age. They want to take the difference in the premium and invest it. Well, where do they want you to invest it? right? They want you to invest it in a qualified retirement plan. Well, now you've got to go down I don't want to say the rabbit hole, but the legitimate understanding of the characteristics of qualified plans, right? I mean, you're limited with the Roth, it's tax-free, I get all that. But I mean, that if you're going to introduce that, invest the difference, then you've got to search, research, look, consider the characteristics of this investment, right? Okay. Well, and it's most common that it's a qualified plan. Well, if I put money in a qualified plan, I'm a young person. Now I'm separating myself from my capital straight out of the gate, right? I'm going to get a tax deduction today. That's the motivation. Oh, you're going to save money on taxes. No, you're just postponing the taxes and you're postponing the calculation. Right? And if I put the money into a 401k and I say I'm separating, I can always get mad and quit, right? And then pay taxes, ordinary income the day I quit, the year of receipt. But if I don't, and I'm putting that money, letting the money managers, or it could be an index fund, whatever it is, you put it in there, you separated yourself from that. You can either get mad and quit, right? But then, if you're at an employer, you got to be separated from service. And there's all the characteristics and limitations that you have as an owner of a qualified plan, and you should just be aware of them. And I'm drilling it down. I'm not settling an argument or living and dying on one point. I'm just pointing out the fact that I've separated myself from my capital. And I did a work in 2013. It was released on the 100-year anniversary of the Federal Reserve called the Banking with Life DVD. It's supposed to be available in rental at bankingwithlife.com in the store. We've had issues with the rental and still have the DVDs. I mean, you can call and you can watch it. It's still the truth is the truth and will always be the truth. All right, so I did a work on that over 10 years ago that just kind of gets into it a little bit deeper on the duration and the whole concept of a qualified plan and separating yourself from that capital. So here I'm a young person or old person. The age doesn't matter. I'm going through life. I'm trying to accumulate capital for myself and for the people and the things that I love now and in the future. And I put a lot of capital into a qualified plan, then I've separated myself. I either have to get mad and quit if I can, or I can borrow against it, right? Well, okay, what are the limitations there? You can only borrow 50% or $50,000, whichever's less. Well, that's a limitation. So if my capital is going there and I don't have access to it, then I'm beholden to the third-party lender. Credit cards, credit unions, local banks, HELOCs, lines of credit, whatever they may be. And now I've introduced a new gatekeeper, an additional gatekeeper. There's already the qualified plan document that rules on the operation of a 401k, right? 403b, whatever qualified plan that you put your money in. That is a gatekeeper to your capital. Now, you're going to introduce another gatekeeper, the third-party lender, that's going to dictate to you, because you can't access your own capital, so you're going to access somebody else's capital. They're going to dictate to you how, when, all their limitations, right? Which that life may be beautiful and work out for some. Right. I'm just saying that there's an alternative, and when you think through the infinite banking concept, think through these drive-by comments a lot of times, the little misunderstandings, the incomplete points of view, push through that. All right? Just look at all the characteristics of term. Look at all the characteristics of whole life. You don't have to be a life insurance expert. Consider the characteristics of a qualified plan. Consider the requirements of third-party lending. Who's really controlling that? Not you. And this is the fundamental, foundational truth about the infinite banking concept. Who is controlling the banking function in your life? And that is what the infinite banking concept changes. Right. It changes from whoever they are to you. and it does take time. And whenever you can control the banking function in your life, then you can start to really experience what that means. Not just hearing it, not just thinking that, oh, this is going to happen now. No, actually experience controlling the banking function in your life, and it will change your life. It'll change the direction of your capital. It'll change the direction of your capital for more than one generation. So there are benefits to the infinite banking concept that go well beyond life insurance, rates of return. So my encouragement is to push through the noise, push through the pushback. I love Herbert Spencer. It's I pulled it up. I've used this. I think it was on my email as a footnote at one time. It's attributed to Herbert Spencer. I'm going to continue to attribute it to him. There's a principle which is a bar against all information, which is proof against all arguments, and which cannot fail to keep a man in everlasting ignorance. That principle is contempt prior to investigation. Ruminate on that for a minute. That's pretty powerful. Okay, so the cost, cheap term cost, expensive whole life cost. Well, how? So now you're going to look at duration, right? Rates of return, all of that. Just compare the characteristics. Graduated age 90 with no death benefit. Graduated age 90 with being undercapitalized, right? To get into the banking position, to control the banking function, you have to have capital, right? So the dividend paying whole life insurance properly structured for you. What does that mean? Properly structured. I know that's very broad. Structured for you and your family in your own circumstances, in your own duration, within your own abilities and expectations. Okay. All right. Another very common, and you still hear it, you've heard it, and you'll probably continue to hear it, is the life insurance company keeps your cash value when you die. So all these salesmen, life insurance salesmen, get them out of your house, Dave Ramsey, run them out of your house. How disrespectful, to a profession. The Mino Life Insurance Company keeps your cash value when you die. No, they do not. They don't. They've put that capital to work. It's not yours. Number one, when you pay a premium, it's the property of the life insurance company. Your policy has a guaranteed cash value with a non-guaranteed component, and you have a contractual right to access that. You can get mad and quit, or you can borrow against it. Okay, and you may or may not borrow. People may or may not borrow against cash value life insurance. And as well as I, this is not a new concept, cash value life insurance, to have a loan provision. All of these things out there, what would the Rockefellers do? What would the millionaires do? What would this do? What would that do? Like this is some big secret. No. People used to accumulate capital. I say used to, prior to, really the 70s, going all the way back into the last 2 centuries, people have accumulated capital in life insurance policies. So I went a little bit deeper into some of these points than I originally thought I would. So we're going to end it here. Pick up from here in part 2 next week. Be sure and tune in and listen. You don't want to miss it. And like and subscribe and even share while you're at it. Thank you. Have a great day.
Thank you for joining us on the Banking with Life podcast. If you're watching on YouTube, make sure to like and subscribe and click on that little notification bell. Otherwise, join us on Apple Podcasts and Stitcher for weekly content.